The next few minutes could change your perspective on investing or give you a moment to pause and evaluate what you're currently doing. The investment industry has evolved over the last several years to a more managed or fee-based and consulting model. Both are typically mutual funds or managed money options, but they effectively remove the advisor from the decision-making process, giving it to others, or an investment by committee process. Asset management is difficult. Research is time-consuming. So ask yourself, how engaged is your advisor in the decision-making process? How actively managed is your account? I'm not talking about over trading. I just mean the activity in the account provides you a means of evaluating, is someone watching the store? Is someone watching my portfolio? The investment industry has also become very standardized and sterile, meaning very little adjustments over the course of your investment time frame, and not a very well executed exit strategy or even the ability to raise cash when the markets get increasingly volatile. The industry is also compressing fees, which can be cheaper, but where is the value add when you're getting what everyone else is getting? Has cheaper been better? Perhaps over the last 2 years with the S&P up to 20+%, it has been. What about so far this year? Markets have divergences. Divergences are the difference between the best and worst performing sectors of the market. And with volatility, that provides opportunity. Or do you just set it and forget it and hope it works out? Does your have a little bit of everything allocation strategy work in a narrow market? Probably not. Bottom line, how effective is your current process regarding performance and fees? Do you know what to expect? Regardless of the process that the advisor or the firm utilizes, it typically ends up being a managed portfolio of mutual funds, which carry additional fees, internal fees of the fund and external fees that an advisor charges on top of that. So you could be overpaying. If you're working toward or at retirement, ask yourself 3 questions. What do you own? Why do you own what you own? And do you know what you're truly paying? My name is Brett Lewis. I'm the founder and managing director of Strong Tower Wealth Management, a comprehensive wealth and asset management firm located in Franklin, Tennessee. We're going to discuss these 3 questions, but if you'd like, you can go directly to our website for some more information. What do you own? When you were looking to invest, you probably filled out a risk tolerance questionnaire to determine how comfortable you were with market risk. You probably chose between one of 3 asset allocation models, and we'll use 3 just for this exercise. It was broken up into 3 broad asset classes: equities, fixed income, and international. You chose between an aggressive, moderate, or conservative allocation. And you'll notice that the fixed income allocation gets increasingly larger as you move away from aggressive to moderate to conservative. Over the last couple of years, strong equity returns have masked the underperformance of bonds. Here's a performance quilt. Now, this breaks down the various sectors of the market and allocation strategies, and we're going to discuss these 3 areas with the 3, 5, and 10-year returns. You'll notice that the long-term returns for international have been low. You'll notice fixed income has been completely negative without any positive returns in the last 10 years. But please keep in mind, the equities are the only consistent positive returns of the 3 asset classes. Why do you own what you own? With these particular models, most people at retirement do not want to be aggressive, so let's just remove that one. So now what did you choose? Moderate or conservative? Conservative because you need to be careful at this stage of your life? Was it a result of you answering the risk tolerance questionnaire and that determined your asset allocation model? Was it recommended by your advisor? Or was it recommended because it's diversified and optimized and simply what people do at this point in their life? We're going to come back to this. What is Strong Tower Wealth Management's investment strategy and platform? Strong Tower utilizes a relative strength or momentum strategy, meaning we're attempting to hold the strongest and favored sectors of the market for as long as we can. Sectors rotate in and out of favor over time, and we need to adjust and adapt our model and our buy and sell strategies accordingly. Here's a typical asset allocation model based upon the 11 industry groups or sectors. All firms utilize this type of model. A few of these sectors have underperformed, and some consistently and severely. Last year, 2024, the worst performing sectors of the 11 sectors of the market were energy, healthcare, consumer staples, and basic materials. Consider this. If you were not invested in the weaker areas of the market and had your funds allocated and overweighted in the stronger, more favorable areas, do you think your returns would be higher? This strategy is relative strength and momentum investing. Now let's start tying this all together. We're going to take various areas of the pie chart from the conservative model and look at the fixed income allocation at about 40%, international is about 10%. Now let's take the underperforming sectors of the domestic equity portion of that allocation. Energy at 5%, healthcare at 5%, consumer staples at 5%, and basic materials at 5%. If you add all these together, that's a 70% total. So let me ask you, if 70% of your money is in underperforming or weak areas of the market, is 30% of your allocation or your model carrying the load for their return? Now that may work well when the markets are strong overall. But at the end of the day, if we have a flat or narrow market, is 30% of your money, all that's working, going to make your retirement asset goal possible? Probably not. Why do you own what you own? The thought process is as you near or in retirement, you need to be more conservative with those funds. And fixed income is supposed to represent a diversification and lowering of the risk. I'm going to push back on that point like this. Fixed income and bonds are subject to interest rate risk. And as rates rise or fall, that affects the value of your bonds and fixed income allocation. Owning the strongest performing sectors isn't difficult. However, it takes time, effort, and oversight, but most importantly, an engagement and an execution of that strategy. That's what we're here to do at Strong Tower Wealth Management. Do you truly know what you're paying? We briefly discussed the dual fees on mutual funds, the internal fees the manager charges, and the external fee an advisor charges on top of that. Strong Tower Wealth Management does not charge anything except an external fee to our clients. Do you know what those fees are? And can I show you what they are if you don't know? Are you content to be involved in what the majority of the investment community is providing? Are you content to follow the herd? In our opinion, retirement funds are still long-term funds with a long-term investment strategy. In closing, perhaps you need a review of what you currently own. Perhaps it's time to look under the hood to fully understand what you own. Again, what do you own? Why do you own what you own? And what are you truly paying for your investment strategy and advice? Perhaps it's time to have a conversation with Strong Tower Wealth Management and see where your investments fall within our strategy. Strong Tower Wealth Management, not just when it matters, but when it matters most.